But let's get in Aditya Welekar, the Senior Research Analyst, Metals at Axis Securities, who joins in. Hi, Aditya. Good morning. Good to see you in. Aditya, first that point that BofA was making, we have seen price hikes, but they believe there is room for another price increase on the steel prices here in India. You agree?
Yeah, good morning, Nigel. Yeah, so Q4 is a seasonally strong quarter usually for metals and steel in particular. So in the month of March, we could see we cannot rule out the probability of price hikes. Means on an import parity basis, we are almost at parity with the Chinese imported steel prices. Earlier, before the safeguard duty, means when the safeguard duty was in limbo, the import means the steel prices were trading at a discount of 12%. Now that discount has come down, but overall, because of the seasonal pickup and overall Q4 being a seasonally strong quarter post prolonged monsoon, so we could see some price hikes. It cannot be ruled out at this point of time.
Okay, price hikes cannot be ruled out. Interesting. Who is best placed, Aditya, according to you, from the ferrous names? Because we have price hikes that have come about. I know that, coking coal costs as well have gone up. But in terms of spreads, first let's talk about spreads. What spreads are you assuming for the domestic guys, and how does it compare with, say, the last quarter? Because price hikes are good, but input costs as well have moved up. Though overall, there should be expansion. Go ahead.
Yeah, so the spreads will be mostly driven by the hike in the HRC prices, which have increased by almost 4,500 to 5,000 rupees per ton, which will be partially offset by higher coking coal consumption cost because coking coal prices have moved up, inched up a bit in Q3, which will be consumed in Q4. So that increase will be almost $10 to $15 per ton in coking coal. So overall spreads could likely increase by 3,500 to 4,000 rupees per ton in Q4 as compared to Q3.
And who is best placed? Some believe SAIL is best placed, because they have some benefit in terms of backward integration. Their product mix as well is evolving. MK actually had come out with a note, and they are talking about SAIL being best placed because the product mix is evolving. That's less amount of semis, more amount of finished steel. They have operating leverage, and they believe that debt has peaked out. What according to you is best placed on the ferrous names?
Yeah, Nigel. So I think all these names, they all look best placed, but means to individually point out SAIL for in the shorter term can be a trading bet because it has a long steel exposure and long steel prices have picked up. Debt has remained under control, and in last 3-4 quarters we have seen that SAIL has delivered a good sales volume, and in Q4 also we expect that the sales volume will be strong.
Okay.
And it is sensitive to coking coal prices, so its operating leverage increases once the HRC prices increases. So from that perspective, SAIL looks good, but in the longer term, it is expanding its capacity from 20 to 35 million ton, and the expansion track record in the previous cycles we have seen was not at par. So that is one risk which remains for SAIL in the medium to long term, because the immediate East Coast steel expansion, the capex intensity will rise.
Right. So who do you like then? Aditya, which is best placed in the ferrous names?
So I think this with the recent rally which we have seen, the valuations have caught up most of it, but Jindal Steel and Power, JSW followed by Tata Steel and then by SAIL will be my picking order.
All right. So Jindal Steel, top of mind. Got it. Aditya, let's focus on the non-ferrous names then. First, between ferrous and non-ferrous, what do you like?
Ferrous looks slightly better placed. Non-ferrous, we have seen a good rally, so the valuations have caught up a bit, and ferrous, there is some room for upside.
Aditya, I wanted your view on this. So much of talk about data center, AI as well, and that could be a bit of a tailwind for, base metals, aluminium as well as copper. So do you think there'll be a substantial tailwind, point number one? And point number two, on this point of substitution between, copper being replaced by aluminium, because if I plot the copper price and aluminium price, now the ratio is at around 4x. And some believe that, at that point of time, there is some substitution that takes place, and that's why aluminium could outperform copper. Your comment on that?
Yes, Nigel. So aluminium fundamentally looks slightly more sound than copper at this point of time. So I will just talk some facts that copper inventory has increased across Comex, LME, and SHFE. Post these lunar holidays, the inventory is social inventory in China is also slightly higher. So copper, we may see a medium-term supply slightly exceeding the demand. On the other side, aluminum smelters are shutting down. Recently, we have seen that Century Aluminum Smelter in US has shut down because of the power issues, and Mozal in Mozambique, which has a 0.5 million tons of capacity, and that is an important smelter which provides aluminum to Europe, that has also shut down. So aluminum being power intensive is slightly more vulnerable with respect to the power sourcing, and that puts it in a tight spot. And supply demand fundamentals are more supportive for that. As far as substitution is concerned, yes, means if copper prices rise, we could see some use cases where some instances where we can see substitution. But copper has its unique advantages over aluminum vis-a-vis conductivity and some other technical parameters. But overall, both these base metals, we are positive in the medium to long term. Short term, copper may see some consolidation, but in the longer term, because of the concentrate issues, supply concentrate issues, copper is also well placed.
Beautiful. Thanks a lot, Aditya, for joining in, breaking it down for us. Prefer ferrous in comparison to non-ferrous, post the recent outperformance of the non-ferrous stocks. And also, he says from the ferrous stocks, he prefers Jindal Steel because they have operating leverages play out, they're adding capacities as well.